If you're looking for a simple way to generate income from your investments, dividend ETFs can be incredibly powerful. But here's the problem, not every high-yield ETF is created equal. Some prioritize dividend growth. Others prioritize current income. And some use options to generate unusually high distributions. So today, we're breaking down 7 dividend ETFs you should know about in 2026, and the trade-off that comes with each one. Before we get into the funds, there are a few things you should look at. Don't just chase the biggest dividend number. Look at the expense ratio, diversification, dividend sustainability, total returns, and the strategy the ETF uses to generate income. Because a huge distribution doesn't automatically mean a better investment. Let's start with SCHD, the Schwab US Dividend Equity ETF. This is probably the most balanced fund on this list. SCHD tracks the Dow Jones US Dividend 100 Index and currently holds about 100 stocks. As of August 2026, its expense ratio is just 0.06%, while its 30-day SEC yield is about 3.25%. What makes SCHD interesting isn't simply the yield. Its methodology focuses on companies with characteristics such as cash flow, return on equity, dividend yield, and dividend growth. So SCHD is more of a quality plus income approach rather than simply chasing the highest payout. The trade-off? SCHD isn't designed to produce the biggest income distribution possible. Its strength is the balance between income, quality, and potential long-term growth. That makes it more interesting as a core dividend holding than as a pure income maximization tool. Next is VYM, the Vanguard High Dividend Yield ETF. VYM takes a much broader approach. It currently holds more than 600 stocks, giving investors exposure to a huge basket of large U.S. companies that pay relatively high dividends. Its expense ratio is only 0.04%, and its latest 30-day SEC yield is around 2.25%. One of the biggest advantages here is diversification. Instead of concentrating your dividend portfolio in a smaller group of companies, VYM spreads your exposure across hundreds of holdings. The trade-off is that VYM's yield isn't the highest on this list. But if your priority is low fees and broad diversification, that's exactly what makes VYM interesting. Number 3 is SPYI, the State Street SPDR Portfolio S&P 500 High Dividend ETF. SPYI is much more focused on current dividend income. It selects the 80 highest dividend-yielding companies within the S&P 500. As of August 2026, SPYI has a 0.07% expense ratio and a 30-day SEC yield of approximately 4.12%. That's considerably higher than SCHD and VYM. But there's a reason you shouldn't simply look at that number and declare SPYI the winner. SPYI's portfolio is more heavily tilted towards sectors such as real estate, consumer staples, financials, and utilities. That means you're getting more income, but you're also accepting a different sector mix and potentially different performance characteristics. Higher yield doesn't automatically mean higher total return. Now let's talk about DGRO, the iShares Core Dividend Growth ETF. DGRO takes a different approach. Instead of focusing primarily on today's dividend yield, it focuses on U.S. companies with a history of growing their dividends. It currently holds around 390 stocks, has an expense ratio of 0.08%, and its latest 30-day SEC yield is about 1.97%. So if you're more interested in growing your income over time rather than maximizing today's payout, DGRO becomes much more interesting. The obvious trade-off is the lower current yield, but that's intentional. You're essentially choosing dividend growth over maximum income today. Number 5 is JEPI, the JP Morgan Equity Premium Income ETF. Now we're entering a completely different category. JEPI combines a portfolio of large-cap stocks with an option strategy designed to generate income. As of August 2026, JEPI has a 0.35% expense ratio and a 30-day SEC yield around 7.88%. And unlike the previous ETFs, JEPI makes distributions monthly. That's attractive if your priority is generating regular cash flow. But here's the trade-off. Option strategies can limit some upside compared with simply owning the underlying stocks. So JEPI isn't just a stock ETF with a bigger dividend. It's a different strategy designed around income generation and risk management. Then there's JEPQ, Think of JEPQ as the more Nasdaq-oriented cousin of JEPI. It combines exposure to large-cap companies associated with the Nasdaq 100 with an options-based income strategy. As of August 2026, JEPQ has a 0.35% expense ratio, and its latest 30-day SEC yield is around 15%. But don't look at that number and assume you're getting a guaranteed 15% return. The distribution comes from a strategy involving equities and option-related income, so the economics are very different from a traditional dividend ETF. JEPQ may appeal to investors who want higher income while maintaining significant exposure to growth-oriented stocks. But the higher income comes with strategy complexity and the possibility of giving up some upside. Finally, we have SPYI, the NOS S&P 500 High Income ETF. SPYI uses exposure to the S&P 500 combined with an option strategy to target high monthly income. Its management fee is 0.68%, and as of July 2026 its distribution rate was about 12.04%. But this is where you really need to understand the difference between a distribution rate and an SEC yield. SPYI's 30-day SEC yield was only 0.47%. That's because the distribution can include option premiums, dividends, capital gains and return of capital. So 12% does not mean the fund is earning 12% in ordinary dividends. So which one is actually the best? There isn't one answer. If you want quality and balanced dividend income, SCHD stands out. If you want maximum diversification and low fees, VYM is compelling. If you want higher current dividend yield, SPYD deserves a look. And if your priority is monthly income, JEPI, JEPQ and SPYI operate in a completely different category. The biggest lesson here is simple. Don't choose an ETF simply because its yield is the highest. Look at what you're actually getting in exchange for that income. Fees, diversification, dividend growth, total return, option strategies, and risk. The best ETF for you is the one whose strategy actually matches your financial goal. And remember, these aren't recommendations to buy or sell anything. There's simply 7 ETFs worth understanding before you make your own decision. If you want more straightforward investing breakdowns like this, subscribe to Money Minds. And tell me in the comments, which of these 7 ETFs would you research first?